Looking for steady passive income? Covered call ETFs are getting a lot of buzz lately, with promises of double-digit yields that sound almost too good to be true. In this video, we'll break down how covered call ETFs actually work, how they generate income, and what to watch for when choosing the right one for your portfolio. If you're looking for steady income from your investments, whether you're retired or just planning ahead, you probably want something that pays you regularly without having to sell anything. Sure, you could invest in a portfolio of reliable dividend-paying companies, or ETF holding such companies and receive regular payments. Nothing wrong with this choice, except, let's do some calculation. This portfolio will yield at best about 6% annually. Your $500,000 portfolio will give you $30,000 per year or $2,500 in monthly payments. That means, in order to increase income, you have to sell the portion of your portfolio. What if I tell you about ETF, which pays you monthly and yield 12%? Same, $500,000 will provide you $5,000 in monthly payments. Demand for steady passive income is growing, and financial industry is responding. Most common strategies to provide steady income are leverage, covered calls, selling, or combination of both. Covered call ETFs can deliver eye-opening yields without requiring you to trade individual options. But how do they work, and are they right for you? In a nutshell, what is the call option? Imagine you want to buy a vacation package in a high season, but you're not sure yet. So, you pay a small fee to reserve the right to buy it at today's price, even if prices go up later. If the price goes up, you saved money. If it drops or you change your mind, you just lose the reservation fee. A call option is a type of financial contract that gives the buyer the right, but not the obligation, to buy a specific stock at a certain price, called the strike price. Before a specific date, the seller receives premium. A covered call strategy involves owning stocks or an index and then selling call options on those holdings. In exchange, you receive premiums up front, which become your regular income monthly or even weekly. If the underlying asset stays flat or declines, you keep the premium. However, if it rises above the option strike price, your upside gains are capped. Covered calls ETFs simplify this process by handling the option selling for you. The fund holds a diversified portfolio of equities and actively writes call options on part or all of its holdings, distributing the premium income directly to investors. This is just a simplified take. Real strategies are way more complex. There are hundreds of these ETFs out there, each doing things a little differently. Some perform better than others, so take your time, dig in, and pick what works best for you. As of February 2025, there are around 200 funds in Canada managing over CAD $30 billion. Interestingly, assets under management have nearly tripled over the past 5 years. Before we dive into real-world examples of covered call ETFs, let us take a moment to highlight a few important things you should watch out for when chasing high yields. First rule of thumb: the higher the yield, the higher the risk. Second, good idea to check the history of ETF. How it performs over the time. Is it NAV net asset value is rising, or at least steady? Declining NAV signals ETF has not enough earnings to sustain current distribution. It's red flag. Third, watch out if you're reholding these in a non-registered account. The payouts can be a mix of qualified dividends, ordinary income, and return of capital, and each gets taxed differently. In general, take the time to educate yourself. The more you learn, the smarter you'll invest. Alright, let's check out as such ETFs available in Canada. Just a reminder, this is not an investment advice. I just grabbed a few interesting ones to show you how covered call ETFs actually work. First, there's the CNCC, the Horizons Canadian Large Cap Equity Covered Call ETF. It gives you exposure to Canada's largest companies with an added twist. The fund writes covered calls to generate monthly income, expect steady payouts, around 8 to 9% yield, all while keeping your capital invested in big-name Canadian firms. It's a smart way to combine income with market exposure. Next, the HDIV, the Hamilton Enhanced Multi-Sector Covered Call ETF. It delivers attractive monthly income around 11 to 11.5% yield through a multi-sector approach that spans banks, utilities, and technology with roughly 25% leverage for extra boost. It aims to outperform the S&P/TSX 60 with more income and growth potential in one easy-to-own package. Then we have CDAY, the Hamilton Enhanced Canadian Equity Day Max ETF. This fund is new, so there's no track record to review yet, but I wanted to mention it because of its unique features. It offers solid exposure to Canadian equities with added twists. By layering on daily 0 days to expiry call options and using modest leverage, CDAY targets higher, semi-monthly income while still keeping upside potential. It's Canada's first ETF to use this innovative income strategy. and it's designed specifically for investors looking for consistent payouts from Canadian stocks. Now, in the US, as you might expect, there's a huge variety of highly competitive ETFs offering eye-popping yields, paid monthly or even weekly. First, GPIX Goldman Sachs S&P 500 Premium Income ETF invests primarily in S&P 500 equities and dynamically sells covered calls on 25 to 75% of its holdings to generate income. Delivers consistent monthly distributions today, about 8%, along with potential for long-term growth. And for those who lean towards tech exposure, GPIQ Goldman Sachs NASDAQ 100 Premium Income ETF invests in the NASDAQ 100 index and uses a dynamic covered call strategy on about 25 to 75% of the portfolio to boost income. Designed to offer high monthly income, today about 10%, while retaining exposure to tech-driven growth. You could consider SPYI QQQI S&P 500, our high-income ETF, which has a trailing yield of around 12% by selling options on the S&P 500. Then there's QQQI NASDAQ 100 High-Income ETF, known for yields about 14% range, by focusing on the tech-heavy NASDAQ 100. Do you want to get paid weekly? Check out ULTY, the YieldMax Ultra Option Income Strategy ETF, which pays weekly. If we calculate the current yield based on the latest payout and recent price, it comes to an eye-popping yield. But just a reminder, this is a high-risk investment. Sure, there are plenty of other high-yield ETFs out there that generate income from sophisticated strategies and volatile assets, including high-growth individual stocks and even Bitcoin. So, what are the pros and cons of covered call ETFs, especially for income-focused investors? On the plus side, they provide attractive yields, often outpacing traditional bond or dividend ETFs. The premium income can help cushion against market downturns. Their regular income distributions make them particularly appealing for retirees and income-seeking investors. However, there are trade-offs. When markets rally, your gains above the strike price are limited. These ETFs also usually carry higher management fees, and the tax treatment of option premiums can be somewhat complex in taxable accounts. Additionally, during strong bull markets, covered call strategies may underperform pure equity ETFs. Who should consider covered call ETFs? They work best for investors prioritizing income and lower volatility like retirees or those who want steady cash flow. Ideally, you would allocate only a portion, say 40 to 50% of your overall portfolio to these income strategies. If your focus is on aggressive capital appreciation, covered calls might not be the best fit, since they naturally limit your upside potential. To use covered call ETFs smartly, start by clarifying your financial goals. Do you need immediate income, or are you more focused on long-term growth? Treat these ETFs as your income bucket, not the entirety of your portfolio. Diversify by rotating between few different covered call ETFs, and whenever possible, hold them in tax-advantaged accounts to mitigate some tax complexities. And remember, regular portfolio rebalancing is essential as market conditions change. In summary, covered call ETFs can be a powerful tool for generating consistent income, but they come with trade-offs such as capped upside and higher fees. If steady cash flow is your primary goal and you're comfortable with these limitations, they might be a valuable addition to your investment strategy. Thanks for watching. If you enjoyed this deep dive into covered call ETFs, please subscribe for more investing insights. Until the next time.